you know, our own limiting beliefs also stop us from, you know, going into home ownership sometimes.
Right.
It's not for everyone, and I can say that, but if you have the belief that you definitely want to be a homeowner, but in your mind you keep on telling yourself no, you watch the news and home prices are continuously going up, interest rates going up, so then you're like, oh, now I really can't. So
yeah. So this video, and I'm sure there will be more, but in this meeting, we wanted to talk about the common questions that consumers ask. And I know that as a mortgage broker, our clients usually ask us questions that are more for a real estate agent, and I'm sure as a real estate agent, clients will ask you questions that are really should be guided to a mortgage lender or a mortgage advisor. So I'm glad we're finally able to do this. Why don't you tell us about you and your company that you've launched?
Awesome. So for those that don't know me, my name is Maabi Munoz. I am the sole owner of J. David Real Estate Agency. And I've been in the industry now for almost 8 years, and it's been wonderful. I love it.
That's great. That's awesome. Well, congratulations on J. David. I love the logo. I love the launch, and I'm excited that you started your own real estate company. And so my name's Adrian with Mortgage Cafe Northwest, and I'm a co-partner, co-founder here at Mortgage Cafe Northwest, and we are a mortgage broker and based out of Tigard, Oregon, and we lend in Washington and Oregon. Mortgage Cafe has been around for 6 years now, but I've been in the industry, we were just talking about this earlier, I've been in the industry for about 17 years now as a mortgage lender. So, and you and I both own our own business, and I think that allows us some freedoms. So it allows us some freedoms. I know we wanted to be politically correct, and we will be, but you know, it allows us some freedoms to tell the consumer the truth. We don't have hidden agendas. Like, as a independent, truly independent mortgage broker, I don't report to a regional manager or a district manager or a sales manager. Like, I'm only responsible for myself, my partner. I'm responsible to my business partner and my team, and that's it, you know. And Maabi, that allows us to speak honestly to the consumer where maybe others can't, because they're tied to a corporation or they're restricted by a bank or, you know, whatever it is. And so I can let my hair grow out with nobody telling me not to, except for maybe my wife. I don't know, but you know, it's liberating, and I think it's important to the consumer to know that you and I own and operate our own small business here out of Oregon and Washington.
Yes.
Yeah, and it's important for them to know that, because, well, number one, they're working with a small business, and number two, we don't have an agenda that's based on a corporation or restricted by any management, right? Does that make sense?
Yeah, and as Latinos, we are the owners, and so I think that there's also pride in that.
Yeah.
You know, we're the owners. We are the Latino. You know, you have your own mortgage, your brokerage company, and I'm a real estate agent. So that's awesome.
Yeah.
There's not that many of us. So
yeah,
I take pride in that as well.
That's good. So as a consumer, I keep hearing that prices are going to fall, Maabi. They're going to crash. The housing market is going to crash. And should I wait to buy a home until it crashes?
You know, it is interesting, and that is, unfortunately, the media plays, I think, a lot with that, where we hear, you know, how home prices are falling, and I can say on personal experience, I hear the same thing, right? I get the question asked. It doesn't matter where I go. It's, so do you think that home prices are going to, you know, are they dropping? Mm-hmm. And I had somebody actually tell me yesterday, well, now that home prices are dropping, let me just be clear. Home prices aren't dropping in the sense that we might all be thinking of, where, you know, home prices are coming down. The truth is, we got accustomed to a certain price point, I should say. And everybody was able to, because some of this we're going to play and talk to as well, as interest rates were so low, everybody was, you know, out trying to, you know, getting qualified for homes. And there was a shortage in inventory. And that's key. There was hardly, you know, not that many, very, very few homes on the market, maybe 400 at one point, maybe, you know, not a lot. Now what's happening is that we have more homes on the market. I think we're like at 1,400 homes on the market, maybe more. I just read it the other day. So what's happening is sellers, you're accustomed to seeing your neighbor sell his house, you know, 2-3 months back at a higher price point, getting multiple offers. Great. The market has shifted. It shifted right around May. And so that's the only thing that has happened. And so instead of pricing your home at maybe, you know, 800,000 because your neighbor did, it's no longer there. You have to be a little bit more realistic. So what happens is home prices don't drop. It's just they're decreasing because at the time that the home was put on the market was just not, it wasn't there. There wasn't enough buyers. And that's what we're running against now. There's not a lot of buyers like there was a few months back. So
Right.
The other thing I always tell people is that we live in the Pacific Northwest. We're always at the very end of like the bell and of any of the changes. And so should there be any price decrease that is going to be significant, we probably will not see it. I think that we've seen in the years that I've been in the industry, not only as a real estate agent, but as a broker, we've only seen the home prices go up, 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 and up.
Yeah, and you're right. This ties in, obviously, it ties in a lot to interest rates that we will talk about, right? But I like that in that we are a big city, but we're not LA, we're not San Francisco, we're not Seattle, we're not New York.
We're not Seattle.
Right.
We're not Seattle.
So we don't see the drastic shifts as much as they do, right? I think, yeah.
And the other thing, Adrian, is that you see people, you know, the other thing that we tend to hear, at least myself, is, well, it's other, you know, I'm not going to say who they are, but I think we know which state we're talking about when we say, well, it's all them that are coming out here. Let's just be real.
Yeah.
We're still very affordable in comparison to these other major cities.
Right.
And I think thanks to the pandemic that we were in, people started to realize, well, we can work out of our homes.
Right.
And then when you count in natural disasters, Pacific Northwest doesn't really have major disasters year after year. I mean, we have, you know, fires every now and again, but in terms of, you know, flooding, tornadoes, forest fires, all those things that you have, you know, even in the Midwest and the East Coast.
All right. Well, that was the first question for you.
Okay.
And I think you have one for me. We'll go that way. How's that?
Sure. Let's do that. So, well, one of the things like we mentioned before, let's talk about it and get right to it, is interest rates.
Yeah.
You know, what are interest rates at today?
And that's the other thing I hear. Well, I've heard interest rates are high now, right?
Yeah.
It's like, well, I think going back to what you mentioned earlier, the last 2 years have been abnormal, you know, and we got through this period of COVID where the government had to buy or pay to keep these rates down to keep the economy going. So the COVID discount is over, guys.
Can I just tell you, I use that all the time.
Yeah, good.
I use that term. The COVID special is over, people. It's over.
The last 2 years of interest rates were the COVID special. And as we moved out of COVID and starting at the beginning of this year, the Fed said, hey guys, we're done. We're done with COVID. economy should start, everybody's going to start going back to work, everybody's going to start going back to school, and we need to return back to our business as usual mentality. And so as that started to happen at the beginning of the year, then the government said, hey, we're going to stop paying to keep rates low. As a matter of fact, now we have to increase rates because everything's gotten so expensive that we have to do something about inflation. And so to prevent inflation or to reduce inflation, they've started to move towards increasing rates. And so we've gone from the COVID discount of rates being, 3.5% or below 3% in some cases for a short period of time, below 3% and 3.5%, to now around 5.25% to 5.5%, with an APR of about 5.6 to 5.8%. So that's a 30-year fix. Now, Maabi, you and I both know, we've been doing this a long time, that when I spit out rates like this, I have to be very careful to disclose that those are examples based on someone with 740 credit score and the conventional financing. There's so many different factors that determine what interest rate you're going to get. What kind of program are we talking about? What kind of credit scores are we talking about? What kind of debt to income ratio? So there's so many factors that we look at. But right now we're seeing that conventional 30-year fix for somebody with a great scores category right around that 5.25% to 5.5%. And so it's changed dramatically. I mean, this is the fastest increase in rates that we've seen in a long, long time, or if ever, and to go from 3.5% to 5.5%. And so, of course, we're thinking rates are high, but guys, they're not high. We're just back to a normal environment. The last 2 years was abnormal, and that ties into what you were saying earlier with offers, right? I mean, how many clients did we talk to that said, oh, Adrian, I'm not going to go buy a house right now. I don't care if interest rates are 3.5%. I'm not going to go be one of the 50 offers that's on this house, right? Because you had multiple offers. We had price bidding wars going, a house starts at 350 and ends up at 450,000. And so consumers didn't,
at times.
Yeah, consumers didn't want to play that game. They're like, no, I'm not going to play that game. I'm going to wait till it changes. Well, guess what? The change has happened. It's now. For those of you who decided to wait, it's now. The change has happened. And what caused that change was we had to go from the COVID special to a normal market. And we are now in a normal market where it's at 5.25% to 5.5%. And there's, again, it changes every day, but there aren't multiple offers on a house anymore, or at least not as many. And now you, as a buyer, as a consumer, you have a better chance of winning that home because it's not the same environment. So this is where we are. This is where we are now, and it's an adjustment. It's a big adjustment. I felt like in the last 3 months, the industry and the consumer together were both shell-shocked at how fast it changed, but it just returned to what my opinion is a normal environment. And then from here, we just have to decide whether it makes sense for you or not.
Right.
So.
Right.
Yeah.
I think the other day, you and I, we've talked about this numerous times as well. And, I think the question I always get is now a good time to buy?
Mm-hmm. Yeah.
And I always answer, yes, now is a good time to buy. You reminded me of a key factor though. It's not everybody, home ownership as we know it is not for everyone, period.
Mm-hmm.
I don't want to say now is the time to buy. If you are, gainfully employed, it's stable, now is the time to buy. If your credit score is high enough, now is the time to buy. There's all these little factors so the answer is always yes. I'm seeing it now with buyers where they were ready back in December and January, and we were out looking, but they were one of the ones, some few that got buyer's fatigue. That's what we called it, was buyer's fatigue.
Mm-hmm.
So they got buyer's fatigue and we're like, we're going to wait. I'm like, okay. And I have to honor that, right? Because not everybody is in a space to go, to continue looking. It is fatiguing. It's fatiguing even for us.
Yeah. Yeah.
So, but now, so I get a phone call, we're ready to go. And unfortunately, we're running, now it's not so much the price, it's now their payment is, so much higher.
Right.
And the home price that they're comfortable with, the homes that are out there in that price range are not the type of homes that they're looking for. So
right.
That's why I'm like, yeah, I always say, now is the time to buy.
Right.
Now will always be the time, but taking into consideration in those factors that if you are ready, then the time is now.
I think you're absolutely right. It comes down to whether it makes sense for you or not. And also, it depends on the perspective. In other words, I feel like in the past, or there was this sense of like, oh, if I buy a house now, it's going to be worth so much money in 6 months. It's going to be worth so much more money in a year, right? Because home value appreciation was at double digits during COVID. We saw double digits, over 20% in some neighborhoods of value increase. And so, again, back to what we've talked about, it's a normal market. We're not going to see that type of appreciation levels anymore. Not for a while, right? Maybe. And so if you go into it with the mindset of, I'm going to buy this home and it's going to be worth so much money in the future, you may be mistaken. You may be, that's not the purpose of buying your home. The purpose of buying your home is that you want to be able to move into your place without neighbors fighting with you over the parking port, whether, without, having a yard that you can plant your plants in a neighborhood that has your park and you're settling your roots. That's the purpose of buying a home. And it shouldn't be as an investment. It should be as...
Your first home should not be an investment.
Exactly.
But let me say that your first home should not be an investment. And I say that, and I also say, your first home is not your forever home.
Yeah.
And that's what I tell, buyers, especially first-time home buyers. This isn't your forever home. This is your getting your foot in the door so that in 7 years, 10 years, you're able to sell that home and use that equity, because you're going to have equity. That's a given. It's going to be there. It may not be in the double digits, but it's, like the percentage anyways, but it's going to be there. And you use that equity to purchase the home that you really want. Right. The other thing, you were saying that being home ownership, it's not an you're getting into it to establish, roots per se.
Right.
You have to remember also, your rent goes up at least 10% every year. And right now, just like there's a time when, home prices are high, rent is also high. Rent, apartments, you don't see a single apartment right now that says vacancy.
Yeah.
It's easy. Why? Because, they know that home prices are high. They know that, interest rates are high. And so you just kind of calculate it. And so there's not a need. But buying your home, I was doing a little price comparison this morning. And if you're trying to rent a 3-bedroom home, 3-bedroom, 2-bath, in a decent neighborhood, in decent size, you're looking at it at your rent alone. Your rent is anywhere between $2,600 to $3,000 for a single family dwelling. Wow. That means you don't share walls, nothing. Yeah. And so to me, I was like, would a person really be okay with paying $2,600 in rent? Yeah. Where that's not even for their own benefit, or $2,700 and it's their own home. Right. They can do whatever they want. Paint, they don't have to worry about the dog. And so to me, that's also the other thing. It's like, where are you currently? And, you know, what is your belief? Would you much rather, because that's going to continue to go up in comparison to your mortgage payment. That's pretty much fixed for, you know, the next 30 years, unless you make some change on your own.
Yeah, exactly. You know, your mortgage payment doesn't move on you. And also, the only thing that goes up could be property taxes, right? Or insurance, but anything. So that ties in a little bit to my next question that I have for you,
Okay.
Which is it a good time to sell my home, right? Like, and I think this ties into, because a lot of people, and you covered a little bit of this, but a lot of sellers were worried about, yeah, okay, great, I can sell my house, but Maabi, where am I going to go once I sell it if I can't win that offer, if I can't win that purchase?
Right.
So
the answer to that is yes.
Yeah.
It is a good time. It is a good time to sell your house.
Right.
If it's a good time to sell your house, as long as you are well aware and very knowledgeable at the fact that when you sell your home, you put your house on the market, it's not going to go within the first 5 to 10 days. You have to price it. You know, there's some education that goes there in terms of pricing a home so that it's basically, you know, comparable to, it's competitive with everything else it's selling. And then you stand a better chance at, you know, finding, are you downsizing? You know, are you moving out of state? It's still okay to, you know, we're still in a very good place to definitely put your house on the market.
Right.
Just to know that it's not going to go within the first 2 or 3 days.
Well, same thing. Like, this whole conversation so far has been about that mindset. Shift, right?
Yep.
We all, consumers included, mortgage lenders, real estate agents, consumers, we're all having to shift the mindset in that, hey, I'm not going to get 20 offers on my house. But on the flip side of that, when you go to make an offer on your next home, you're not competing with 20 offers.
Correct.
So you have a much more likelihood of having a smoother transition from selling to buying.
Yes.
Yeah.
Yeah.
Cool.
And the other thing is also prepare your home. I think that we were, along with, you know, that time period of, you know, we were in, you know, having the multiple offers. I think that folks were just kind of selling their homes in whatever condition it was in. It wasn't very, the thought wasn't really there in terms of, well, you know, let me repair the bathroom, or let me change the floor, or, you know, let me do some caulking. You really didn't have to spruce up your house because there was a demand.
Right.
Now you have to spruce out your house.
Now you have to yeah, get ready for the date.
Yeah. Exactly. Get it ready for the date. I'm a first-time home buyer. What programs are there? I mean, I'm hearing that interest rates are going up, and it just seems like there's really no hope for me.
Yeah.
Is there hope for me as a first-time home buyer? What programs are out there that will help me out?
Yeah, of course, you know, it goes back to number one, are you in the right position? And as a Latino, you know, as a Latino male and a Latino, I feel like a guidance counselor, right?
Yeah.
Like, here's the deal, guys. It's a good time to buy a home if you're a first-time home buyer, but because of what's happened with rates moving and shifting and increasing to where we were, you're going to have to be on your A game, right? Like, you're going to have, like, it's important that we do the right things to put ourselves in the right position. And so, in other words, the higher your credit score, the more programs you have available, the lower the interest rate, the lower the mortgage insurance that you're going to have. And so I urge all of our young Latinos out there to really focus on being on your A game financially and taking care of that credit score, making sure that you keep your debt low. You know, if you go out and you purchase a car and now you have a $700 car payment or a $600 truck payment, then that's going to reduce the position that you're in terms of being able to buy a house.
What? I can't buy a Tesla?
You can buy a Tesla, absolutely.
It's either the house or gas prices, Adrian.
Right. You can buy a Tesla, but what I'm saying is prioritize positioning yourself to buy your home first, because when you buy your home, it comes down to one of the factors that we look at is your debt to income, and how much do you make and how much do you pay, and that's how much you're going to qualify for, whatever's left over, right? So anyway, yes. There are some first-time home buyer programs out there. You can purchase a home using conventional loan with as little as 3% for a first-time home buyer, okay? 3% down payment for a first-time home buyer. But the scores have to be there. The qualifications have to be there. Using FHA, you can go in at 3.5%. And those are the two common. And we also have some other programs like a conventional home possible or conventional home ready program. And those are for low to moderate income buyers. Now, I was talking to somebody earlier and they're like, well, I make good money. I don't think I'm in the low to moderate. Well, guess what? That in the Tri-County area, those low to moderate incomes is considered, I believe it was 88,000. I'll have to double check that, but it was somewhere between $85,000 to $88,000 for home possible and home ready, depending on the county and the area. So it's a significant amount. And what that program does is it allows you to get a slightly lower rate, slightly lower mortgage insurance, and easier for that first-time home buyer to keep that payment as low as possible. Another thing that I wanted to talk a little bit about is that with the shift in the market in terms of rates, we're starting to see the industry introduce or reintroduce some new programs, and like, how can I keep the rate low? Well, there's a way you can buy down the interest rate, whether you pay points or discount point, you call it different things. And so you can buy down that interest rate to keep it low. But we're also seeing lenders start to reintroduce, because we've seen them before, reintroduce programs like a 2-1 buy down program. And also we're starting to see adjustable rate mortgages. So I haven't talked to anyone about an adjustable rate mortgage, an ARM, in years. Why? Because interest rates on 30-year fixed were so low, we didn't have to talk about an adjustable rate mortgage. And so now we're going to start to see lenders reintroduce the idea of that adjustable rate mortgage, the ARM. And so what that does, it also, there's this because of what happened in the past in 2010 and the economy crash and all that stuff. We won't get into all that, but there is this these negative connotations with adjustable rate mortgages. It's like, oh, those are bad, you want to stay away from them. Well, you want to stay away from the bad adjustable rate mortgages, and as long as you go into a program, any program, eyes wide open, knowing what you're getting into. So maybe, so let me define it a little bit more. So an adjustable rate mortgage is fixed for 5 years. It could be a 5-year ARM. It could be a 7-year ARM. It could be a 10-year ARM. So you go into a mortgage payment with a rate for 5 years. And then after 5 years, that rate may adjust depending on the market. And usually there are caps to how much it's going to adjust the first adjustment. And then subsequently, year after year, there are caps to how much it's going to adjust on you. So in the past, the bad ARMs, they didn't have caps. They went from, oh, great, I'm at 3%, let's just say, and then the first adjustment, whether it's like 2 years later or 5 years later, there was no cap, and all of a sudden you're paying this 8% interest rate, and so now you couldn't afford the mortgage payment, and so now you had to sell your house or foreclose or whatever, and that's what part of the reason why the economy crashed in 2000, housing market crashed in 2010, 2011. But that's not where we are right now. That's not where we are right now. So these adjustable rate mortgages, they have a little more protection for the consumer, where they have caps, and some of them do, some of them don't. They have prepayment penalties. So you can always refinance, you can always sell without having to pay a penalty on on that loan.
On what you're buying.
So those are the kind of programs that you're going to start to see, and they're good. They're good programs. Again, as long as you go into it eyes wide open, understanding what you're getting into, and being prepared for what you're getting into, then they can be very helpful for you. You know, and that's what we do. We educate.
That's exactly what you do.
Yeah.
So I do have a question,
Yeah.
and kind of a follow-up question to that, and that is that I also get a lot is, can I finance my closing costs? Like, is it possible to finance my closing cost?
That's a good question. You can't necessarily finance your closing costs, right? But before COVID, there was a strategy that was very common in the industry, and we're going to start to see it again. Okay. Before COVID, let's say, I always like to talk to people in terms of examples. Maabi, let's say I'm selling my house. Okay. I'm selling my house and I have it on the market for $450. Now the market shift and you're a buyer and you come to me and you say, Adrian, I'm really interested in your house and I'm willing to pay $450 for it. However, I want to negotiate that you pay the closing costs. Well, okay, if I'm paying the closing cost as a seller, then I'm not getting $450. Right. If your closing costs are, let's say, as an example, $8,000, then if I pay your closing costs as a seller, I'm only getting $442,000 for the sale of my house, right?
Yep.
So a strategy that was very common prior to COVID was to say, okay, well, Adrian, instead of paying $450, I'm going to offer you $458. We increase the price by that $8,000, and you say, but you need to pay $8,000 in closing costs. And so what happens is now we've increased the price to $458 with the seller, me paying $8,000 in closing costs. I get the $450 that I want for the sale of my house, and you get the closing costs covered by the seller. And that is absolutely allowed and doable, and we used to do it all the time before COVID, but we haven't seen it because the market was too aggressive. If the seller had to pay closing costs, you were going to lose that offer almost every time, right? So that's the way. The down payment has to come from the consumer, the buyer. You cannot, there's no way to finance that. There's no way to, that comes from you as the buyer, but you can negotiate for the seller to pay closing costs.
Awesome.
Yeah. All right.
Yeah, good.
So, last question that I have for you is, what would you tell someone? Oh, well, I think we covered this. What would you tell someone who wanted to buy several months ago but didn't want to compete with multiple offers and didn't want to pay over list price? We already talked about that.
We
right?
talked about it.
Yeah.
But just to repeat myself.
Yeah.
Don't wait.
Yeah.
If you have everything aligned, and especially if you were pre-qualified, I would say if you've been pre-qualified in the past, like in the last 60 days, 90 days, you were qualified, go back to your lender and find out now that interest rates have gone up. Now, what do you qualify for?
Yeah.
Because that's going to make a difference too. But yes, buy, because again, you're not buying your dream home. This is your home is to get your foot in the door.
Yeah.
That's, this first home is for you to get your foot in the door.
Yeah.
And if you already own a home and you're, trying to decide whether, do we sell, why is it that you want to sell your home? Is it that you want to move out of the city? Do you want to move out further in the country? Do you need more space? Has your family grown? Then yeah, most definitely, now's a good time for you to sell your home and, make it contingent. You can look at another home and make it contingent upon the sale of your home, keeping, timeframes and stuff in mind. But we're going to start to see a lot more homes that are now going to be contingent also.
Yeah.
My answer will always be yes.
If you're in the right position, absolutely.
Absolutely. Absolutely.
Good.
Yeah, for sure. So another question I have for you, Adrian, is how much money do I have to make in order to qualify for a home
Yeah.
right now, especially with, just the where we are? What
Yeah.
do you think, what's a good, annual salary to, to buy a home, especially with, like, let's say medium home prices in Portland are, 600,000. So 650,000. How much do I have to make in order to buy a house for 650,000?
Yeah. So great question. And obviously, I mean, when we look at financing a home, again, we look at all these different factors. We look at the score, we look at your debt. And before I straight up answer it, I would just want to say for any of consumers, anyone out there, if you're thinking about buying a house and you don't know if you qualify or not, just call us and let us take a look at. I tell people, let's let's put all the pieces on the table, and then once we see it, we're going to figure out how we need to put it together, or at the very least, guide you and say, okay, if you do this and this and this, you'll be in a better position to buy, right?
Yeah.
But let's use your example of 650 purchase price. Everything in lending, well, one of the things is debt to income. How much money do you make? How much money do you pay? And usually for conventional loans, the maximum qualification is 45% to 50% of your income, which is kind of high, to be honest with you, but 45 to 50% of your gross income. Okay.
Yeah.
So, in other words, if you make, if that payment on that 650 home is roughly 4,000 to 4,300, depending on the home, then you need to be making about 105 to 115,000 to have the gross monthly income to qualify for that home. Again, that's on if you have no other debt, then from there we have to see, okay, do you have a car payment? Do you have credit cards? Do you have student loans? And then we take those into consideration. But to answer your question on that 650 example, I think that, at that high end of the ratios of 45 to 50%, you're looking at about 105,000 household gross income to about 115,000. And so that's a good range. But again, that's at that 650. Maybe you don't want to buy a home at 650, and maybe you want to take your time and look for a home lower. Then obviously that income would be less. But that's about it. And then from there, like I said, we'll look at student loans and look at car payments and all that stuff.
So what if, so I want to make sure that my payment is going to be, like, I currently pay probably about 2,000 in rent. I can go up to, maybe 2,500, 2,600. What kind of a purchase price would I, qualify for if I want to keep that kind of a payment? I have minimal payments. I've done really well with keeping my credit down to a minimum. My score is high, and I have a few $1,000 saved up that I've been saving through the years. I also have my parents that are willing to, co-sign with me or, gift me some money. But I also like my social life. I like to, be out and about. So what can 2,500, monthly get me? 25 to 26.
Yeah. So, again, there's so many different factors, right? We're going to look at the down payment. We're going to look at, how much you have available. And I'm gonna move a little bit here. And I think at this part, I'm going to share my screen, and the camera might get a little bit weird here. So let me do that. So this is where it's going to get a little funky. Okay, cool. So if we're looking at, can you see my screen?
I can, thank you.
Okay, cool. Yeah, so here I had an example of 650 with 5% down. That's 32,500. And that's a payment of, again, depending on the rate, depending on all these factors, but roughly $4,100 at a 5.5 30-year fixed. And so if you're looking at trying to keep that payment, let's just see what 350 does. And so 350, if you've got 5% down as a buyer, then the 350, we're going to reduce the taxes. Every property has their different property taxes. I'm going to reduce homeowners insurance a little bit, but you can see here that in this example, I'm using a 740 credit score, conventional 30-year fixed at 5.5 with an APR of 5.6. And so that payment is $2,300. So $2,300, and that's a purchase price of $350 with 5%. If you go to 400,000, 5% down, that's $20,000, and 30-year fix, 5.5 interest rate. And then as we increase that price, we might increase the taxes. Every property has different taxes, right? So we have to just know that it could change depending on the house. But at 400,000 in this example, you're looking at 2632 monthly mortgage payment. And again, Maabi, you and I both know this is just an estimate. It's subject to change, obviously, and adjust depending on the person and the time and all that stuff. So,
Right.
Yeah. So I think if you're trying to get into the market, into your first home, and keep that payment between $2,300 to $2,600, you're going to be in that $350,000 to $400,000 range today.
Yeah.
So does that answer your question?
Yes, that answers my question, and that's helpful. Thank you.
Yeah. And so, you mentioned your parents gifting money. That's absolutely doable. Your parents can gift you funds. And so let's say you've got more money down. This is a good question, actually. So at 400,000 with 5%, people may say, well, Adrian, my parents are going to give me another 20,000. And so now we're coming in with 10%. And so that payment went from 2,600 to approximately 2,516 with an extra $20,000 down.
Ooh, so that gives me another question, Adrian. Now, thank you for sharing that. So just by putting an additional, what was that, 20,000 that I'm going to put in?
Yeah.
It only really changed my payment by what, $75 maybe?
It was probably, so 20, it was 2516.
I thought it was 26 something and I lost, but.
Yeah, so 2516 compared to, I think it was 26 and some change. So that's 2632. So it's a little over $100.
It's only a little over $100.
Yeah, about $100.
So would you suggest that, because at 400,000, this is Realtor and me, at 400,000, the home that you're going to purchase, it's going to need a little bit. It's going to need, it's not going to be your dream home again, but you're going to want to paint, you're going to maybe change the floor, add whatever. Would you recommend then at that point that I hold on, or maybe have my parents gift me instead that, 20,000 to make these changes, or maybe hold on? How do I hold on to as much as I possibly can for those repairs?
Right.
It being that it's only going to be about $100, change in price.
Yeah. So,
Payment.
again, it's perspective, right? It's a matter of opinion and perspective. And I think that if you listen to, depending on who you listen to, there are some very, certain people out there that'll say, hey, we recommend that you save 20% to put down. Don't buy a home unless you have the 20% down, and don't, or more money to put down. And look, if that's your deal, that's your deal. No, no judgment. But to answer your question, the longer you wait to get into the market, the longer you're paying rent and sitting it out. Or like you said, maybe you're taking money because you have moving expenses. Like it costs to move into a new home. And maybe you're moving into a bigger home. So now you want more furniture. You need different furniture, whatever it may be. So to answer your question, does it make sense? Well, look, you saw that $20,000 made about $120 difference, right, a month. And so if you're in a position where that $120 it's not a big difference for you, then I would say save that money. Right. Save that money, come in with the 5%. Yes, you're going to have mortgage insurance. Yes, the payment's going to be a little bit higher, but at the very least, you're getting in the game. You're getting into home ownership. You're starting to build your foundation and your roots in your own home.
Right.
And so you save that $20,000 so that you can have some additional funds as a homeowner for expenses that come up. Even just like I said, moving from your apartment into the home costs money. You're going to pay for movers, you're going to pay for U-Haul, you're going to buy your buddy's pizza, whatever it may be. And so that's a good question. You don't need to have 10%, 15%, 20%. As it goes back to my question earlier, you can buy with as little as 3% down if it makes sense for you.
Right.
So
cool. Thanks for showing us too.
Yeah,
that's
of course.
Awesome. It's always nice to see the numbers, kind of breakdown of numbers. It helps me at least.
Yeah, well, and I know that, for us, one of the Mortgage Cafe Northwest, all of our loan officers, one of the things that we pride ourselves in is when you meet with us, whether it's in person or over the phone or virtually, like I tell people all the time, our goal is to make sure that you're well informed and you know exactly where you stand, you know exactly what payment you're getting, what interest rate you're getting, what program you're getting. And you're going out there, by the time you're done meeting with us for your mortgage consultation, then you're leaving here and you shouldn't have, they should come to you, Maabi, with their pre-approval letter in hand, knowing exactly what they're getting into, and really at that point only worried about, is this the right home for us or not? But if they have questions on Adrian didn't really tell me what kind of program we're using, which I hear other lenders do all the time. Yeah, they come to us and they go, well, I talked to this lender and they said we're approved, but they didn't tell us what kind of program, or they didn't tell us about closing costs. And what the hell did they tell you then? Yeah. So we really try to inform everyone. I think those are the common questions. I know this video has gone a little bit longer than what even you and I had talked about initially, but what we're going to try to do is break it down into pieces for you guys and have this content for you. But I just want to make sure that we're available for you, myself and my team as your mortgage counselors, mortgage advisors, and Maabi as your go-to real estate agent. Anything else, Maabi, for them?
No, I think that, we pretty much covered everything. I guess for me, I just can't emphasize enough that if you're ready, then do it.
Yep.
Don't hesitate. I think earlier in our conversation, I don't know if it was part of the recording or not, but when you were asking me about, starting my own business and what my thoughts were, a lot of that, I just started my own business in July. But it's all about mindset. And sometimes we get into our own head, our own limiting beliefs that tell us, I'm not ready.
Right.
I don't want to do it just yet. And we don't. And so we keep on putting it off and putting it off and putting it off, and in hopes that one day we'll be okay. And, by that time, sometimes it gets there. And when you're ready, there's been changes, and then the market's not, you're really not ready because, there's been change in market, right, whether rate or home prices are too high or whatever. So, I'd say take the time and you know, consult, call people over at Mortgage Cafe and definitely have a consultation with them and see where you are. And the beauty, I think, of also working with you guys that I've just known from personal experience is that if I'm not ready now, you're going to tell me you're not ready now,
Yeah.
but these are the steps that you need to take so that you can be ready.
Right.
And when you're ready to, you know, when you're ready, then you're ready. But I think that too many times I've ran into, you know, folks that they're not quite ready and they've never had anybody actually tell them you're not ready.
Yeah. Yeah. Or, yeah. And, or they take themselves out of the market, in other words.
Yeah.
Right? Like they're excluding themselves when they absolutely shouldn't. And you could buy a house.
Absolutely. Right? Yep, absolutely.
Hey, well, I appreciate your time. I hope this has been helpful
Thank
for
you.
everyone. And we should keep doing this. We'll keep putting some content out for people.
Yeah, and definitely, I think that if any, you know, if our viewers have, you know, topics that they would like for us to cover, it would be a, you know, a good idea to reach out to myself or to Adrian and let us know. You know, we'd be more than happy to cover it in this type of a format.
Yeah, awesome. All right, Maabi, thanks again.
All right, we'll see ya.
We'll see you, Chica. All right.
Bye.
Bye.